Every forecast you read heading into 2026 told you the same story. Rates would be back down near 2% by now. Cheap money would return. The pain would be temporary. Then the Monetary Policy Committee sat down, voted 7-2, and held the base rate exactly where it already was, 3.75%, the fourth hold in a row. Two members didn't even want that. They wanted it raised to 4%. Not a cut, not a crash, just nothing. And that is the part nobody prepared British homeowners for, because a spike is dramatic. A spike makes the front pages, and a spike eventually breaks. What Britain has now is not a spike. It is a plateau. A plateau doesn't break. It just stretches out in front of you, mile after mile, until you stop asking when it ends and start asking how much longer you can keep walking. So why does the new normal feel so much less like stability and so much more like a trap? Start with the bank's own arithmetic, because the hold is not stubbornness, it is fear. Headline inflation is running at roughly 2.8%, close enough to the 2% target that the newspapers have largely stopped shouting about it. But the bank is not primarily watching the headline number. It is watching services inflation, the price of haircuts, restaurant meals, insurance, dentistry, car repairs, hotel rooms, the things you cannot import from abroad, and the things that are mostly made of British wages. Services inflation is sitting around 3.7%, almost double the target. That is the number that keeps the committee awake, because services inflation is a wage story wearing a price tag. When wage growth stays elevated, service businesses raise prices to cover payroll, and those higher prices become the argument for next year's pay rise. It is a loop. And the bank has learned, painfully, that cutting into a loop like that is how you end up hiking again 18 months later. So the committee has chosen the least popular option available to it. Hold. Wait. Let the pressure bleed out slowly. That is the decision. Now here is the part that actually hits your bank account, and the part almost nobody explains properly. Your mortgage is not 3.75%. It has never been 3.75%. It is not going to be 3.75%. The base rate is what the Bank of England pays commercial banks on their reserves. It is not the price of your loan. When a lender offers you a 5-year fixed rate, it has to guarantee your payment for 60 months, which means it has to buy that certainty in the wholesale market first. It does that through swap rates, essentially the price of locking in money for 2 years, or 5 years, or 10. And swap rates do not follow the base rate. They follow expectations. If the market believes rates will stay high, swaps stay high, and it doesn't matter what the bank did last Thursday. On top of that swap rate, the lender adds a margin, capital requirements, servicing costs, an assumption about how many borrowers will default, profit. Stack it together, and you get the reality of 2026. The average 2-year fixed rate is around 5.51%. The average 5-year fix, 5.53%. Sharper deals exist below that, but they are mostly reserved for borrowers with 60% loan to value, or better, people who already own most of their house. And if your deal ends and you do nothing at all, the average standard variable rate is waiting at roughly 6.49%, so the base rate held. Your rate did not fall. Both of those things are true at once, and the gap between them is where all the confusion lives. Now, what does a rate actually feel like? Because a percentage point is an abstraction, and abstractions don't keep anyone awake at 3 in the morning. Think of it as a rucksack. Every 1% added to your mortgage rate is roughly 20 kilograms dropped into a pack that you have agreed to carry for the next 25 years. Uphill, into a headwind. 20 kilograms will not knock you over. You can lift it, you can walk with it. On day 1 you barely notice, but you are not carrying it for a day. You are carrying it for 9,000 mornings, and every one of those mornings takes a little more out of you than it should. It doesn't break your finances. It erodes your financial fitness. The holiday gets shortened. The pension contribution gets paused just for a few months. The savings buffer stops growing and starts shrinking. That is what a plateau does. It never lands a knockout blow. It just never lets you put the bag down. Which brings us to the ghost that haunts every remortgage conversation in Britain right now. 2021. 5 years ago, a competent borrower could fix at 1.5%. On a £300,000 mortgage over 25 years, that was a monthly payment of roughly £1,199. Take that same £300,000 today at around 5.5%, and the payment is roughly £1,842. That is a difference of about £640 every single month. Same house, same family, same debt. Nothing changed, except the price of money. Nobody voted for that. It doesn't appear on a payslip. HMRC never sees a penny of it. But it functions exactly like a tax, an invisible one, collected monthly from households who have done nothing wrong except need somewhere to live. And unlike a tax, it doesn't fund a hospital, it funds a margin. So how are people coping? Mostly with a mirage. The most common survival strategy in Britain today is the term stretch. 25 years becomes 30, 30 becomes 35. For borrowers in their 40s, 40 years is no longer unusual. The broker's spreadsheet makes it look like relief. That same £300,000 at 5.5%, stretched to 35 years, drops the payment to around £1,611. You've clawed back over £200 a month. Breathing room, except you haven't lowered the rate. You've lowered the friction. Across the full term, that extra decade costs you somewhere in the region of £124,000 in additional interest. You have not made the mortgage cheaper, you have made it longer. And what you spent to do it was your retirement, the last 10 years of your working life, quietly reassigned from your future to your lender's balance sheet. You feel it on any random morning, at the moment the bank statement lands. The salary arrives on a Friday. By the following week it's gone. Mortgage, council tax, energy, the standing orders. And the uncomfortable thought arrives with it. Your current account isn't really yours. It's a pass-through. Money touches it briefly on the way to somebody else. And here is the consequence almost nobody discusses on the news, because it doesn't fit into a chart. If millions of British households are each handing over an extra £500 a month compared with their old deal, that money has to come from somewhere. It comes out of the high street, out of the Saturday lunch, the pub quiz, the local gym, the independent bookshop, the tradesman you would have called about the extension. It comes out of British risk-taking too. The person who is going to leave the corporate job and start something of their own does not do it, because the mortgage payment now demands certainty, and startups do not provide certainty. From the home counties to the northeast, the same quiet arithmetic plays out. High rates don't just transfer money from households to lenders. They transfer energy out of the real economy and into the financial one. So where does that leave you? With one uncomfortable idea and one useful one. The uncomfortable idea is this: 2021 was not normal. Money at 1.5% was a 15-year emergency measure, a response to a banking crisis and then a pandemic. The current level is closer to the long-run average of British financial history than anything your parents' generation would have called cheap. We are not waiting to return to normal. We already returned. This is it. The useful idea is that if the price of money is no longer something you can control, the amount of money you have borrowed absolutely is. Call it equity resilience. Not a bigger house, not a cleverer product. Simply owning enough of your own home that the loan-to-value ratio does the work for you. Because the best rates in the market are not sold to the highest earners. They are sold to the lowest borrowers. Overpayments, where your terms allow them, are the only lever most households genuinely hold. Wealth in 2026 is not measured by what your property is worth on a portal. It's measured by how little of it belongs to somebody else. Because true freedom is reaching the point where 9 people meet in Threadneedle Street, announce a decision, and your heart rate doesn't move at all. If you learned something from this video, make sure to like and hit subscribe. See you in the next one.